You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is CPA and Rich Dad advisor, Tom Wheelwright. Now, Tom is a leading wealth and tax expert, a global speaker, Entrepreneur Magazine contributor, and best-selling author of Tax-Free Wealth. Tom is best known for making taxes fun, easy, and understandable, and specializes in helping entrepreneurs and investors build wealth through practical and strategic ways that permanently reduce taxes. As a Rich Dad advisor to Robert Kiyosaki, Tom frequently speaks at conferences worldwide to entrepreneurs on these topics. Now, in today's show, Tom and I will be diving into some of the most overlooked deductions that came out of the tax reform of 2017, more specifically, the Tax Cuts and Jobs Act. And so, guys, I'm very excited to get on to the show with Tom, but before we do, I have a few quick housekeeping items. Like I do each and every week, I like to share my one personal and professional best from the prior week. And so the one personal best, guys, Christmas was last week, and my wife and I, we hosted the family Christmas celebration this year by having a majority of our family, both local and from out of state, to our home in Florida. And for those that don't know, I'm very much of a homebody, and I like traveling, but I also don't like traveling. I like my home. I like being in my own environment, and so I relished in the idea of making everyone come to our home versus us traveling, to a different state or to a different location for Christmas. And one of the highlights was Santa Claus bringing my 6-year-old Jackson the Millennium Falcon Lego set, which has roughly 1,500 pieces and is actually meant for much older kids. I think the age on the box was 9 to 14-year-old. And Jackson's 6. He just actually turned 6 in October, so he's a new 6. And, over the last 2 years, Jackson has grown very fond of Legos and has shown an immense amount of focus and patience when diving into a brand new set. And so we've been purposely pushing the threshold by purchasing much more complicated and intricate sets that are meant for older kids. And so this set actually took it to another extreme. Long story short, he woke up one day, a few days after Christmas. He woke up at 5 a.m. in the morning. My wife and I were still in bed. We were sleeping. And at 5 a.m., he began assembling the set while the rest of the house was still asleep. His brother was still asleep in the room next over, and my wife and I were on the other side of the house. And approximately 6 hours later, with only a few pee breaks in the middle, he finished his master creation with zero help from anyone. We were absolutely blown away that he was able to put that entire thing together by himself. Again, 6 years old. The set was meant for 9 to 14-year-olds, 1,500 pieces, just shy of 1,500 pieces in total, and not 1 ounce of help from anyone else. I was again absolutely blown away. I think we have a little engineer in the making, or maybe a real estate developer is what I like to say. I think he's going to be a real estate developer. He's going to be a very creative individual. He's got tons of vision, lots of patience, and I love watching him kind of fall into his element. So that was a very special moment. As far as a professional best, our team just wrapped up our annual 2-day leadership meeting. It's something we do each and every year. Aside from our regular quarterly meetings, this is the end of the year 2-day, get away from the office. We normally rent an office space somewhere else or go somewhere, neat, just to get away from the day-to-day grind here at the office. And so not only was it great to get away from, just the office in general, but really to get away and talk at a much higher level regarding growth strategies and working on the business, not in it. When you get stuck in the day-to-day, it's really hard to get out of the grind and actually be working on the business, not in the business. And so that was phenomenal. It's also great to spend some intimate time with those that we can really attribute a lot of our company's success to. I'm absolutely honored to have such an incredibly talented bunch here at Sunrise. And so it was just a very special 2 days all the way around, and just really proud of what our team's been able to accomplish here at Sunrise Capital Investors. Moving on here, guys. If you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please be sure to take a moment, go subscribe to the show, and also take a minute to leave a review and ratings on iTunes. And like I do each and every week, I like to take a moment to give a shout out to someone that's left a review. And this is from screen name Scooter from Hoover. These names are always kind of funny. Scooter says, Kevin does an outstanding job of bringing in highly educated people that explains their niche in a way that everyone can easily understand. His broad range of guests will encompass any and all types of investors. Well, Scooter, thanks so much for leaving the review. And folks, please go take a few minutes, leave that review, and I'll be sure to give you a shout out in a future episode. Lastly, before moving on here, guys, just want to remind you of the free 30-minute phone call that I offer each and every week, where basically you can sign up to jump on the phone with me for 30 minutes, uninterrupted time. I'm not going to try to pitch you any type of coaching program or sell you anything. This is the way for you and I to connect and talk about everything and anything that your heart desires regarding real estate investing, whether you're brand new or a seasoned investor, whether it's you're looking to get out of house flipping and move into commercial real estate, or you're looking how to raise capital, or anything in between. We can talk about it during those 30 minutes together. Go to my website to schedule that call, kevinbupp.com. Okay, guys, now I'd like to move on to the part of the show that you guys have been waiting for, which is our interview with Tom Wheelwright. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, certified public accountant, CEO of Wealthability, best-selling author, and Rich Dad advisor, Tom Wheelwright. Tom, how you doing today?
Doing great. Hey, thanks for having me on your show.
Yeah. Thanks for being here. Looking forward to it. And we had you, it's been many, many years. It's probably been 4 or so years. So quite some time since we had you on. And so very much looking forward to having you back here. And, we're going to have some fun today talking tax strategy. I know a lot of people don't find fun to be the synonym for tax, but anyway, we're going to have some fun with tax strategy today. But more specifically, talk about some of the most misunderstood deductions of the Tax Cuts and Jobs Act. And for those folks that aren't familiar, and Tom, you could probably go into a little bit more depth than I, but December 2017, the Tax Cuts and Jobs Act was signed into law, and it basically represent the most significant tax code overhaul in more than 3 decades. And it's really not a secret that the changes made with this major overhaul can be a bit confusing, and some folks don't really know what's applicable to them, what's not. And so with that, we're going to focus our time today on that, and we're going to hone in on the most overlooked and misunderstood deductions with this Tax Cuts and Jobs Act. So guys, get excited, because there's a number of benefits here for us real estate investors. And so with that, Tom, let's go ahead and get on with it. And my thoughts are, the big one, the big 800-pound gorilla of this Tax Cuts and Jobs Act was the bonus depreciation part of it. So if you could maybe take a few minutes and give us a little bit of a background of the bonus depreciation aspect and how that plays into us real estate investors.
Yeah, for sure. So you may not know this, but the last time there was a major tax act change, I was actually in Washington, D.C., monitoring it and helping to write the book to explain it to our to the clients of the big accounting firm I was with at the time. So to watch this one and that one, of course, the biggest loser was real estate, and this one, the biggest winner is real estate. So very fascinating, complete flip in who the winners and losers are. And bonus depreciation is, I got to tell you, I travel all over the world, and I have never seen any tax benefit like this one. And maybe I'll just kind of walk through and just explain why this is such a big tax benefit. And a lot of people are not taking this tax benefit the way they should. I mean, a lot. I did just last week, I did a 3-day course with 50 CPAs in the room. And I will tell you, not one of them clearly understood it before the course started.
Wow.
And these are really smart CPAs. So this is something that, it's I'll make it simple so everybody can understand it, but chances are your CPA doesn't understand it either. So just be aware of that you may need to do a little instruction for your CPA. So basically, it really goes back to this whole idea of cost segregation that I'm sure, you've talked about before in your show, Kevin, and the idea is that when you buy a piece of property, you're really buying 4 categories of property. You're buying the land, you're buying the building, okay, we all know those things, but you're also buying the land improvements like the landscaping and the outdoor lighting and the covered parking and even the parking itself. There's a lot of land improvements, and then you're also buying the contents of the building. Obviously the window coverings and so forth, but the cabinetry and a lot of the wiring and cabling, and even some of the like washer dryer hookups if you're in residential or if you're in commercial, some of your other plumbing or high tech stuff. I mean, all of that gets cost segregated into this idea of contents, which is a quicker way to depreciate. Of course, what we want our money sooner rather than later. And we know that land, we're going to get it when we sell it because land doesn't wear out. And buildings, it's going to take, in commercial property, it's going to take 39 years to get our money back, get a deduction back there. But on land improvements, prior to 2017, the rule was 15 years. And for contents, it was 5 years. Well, that was great. So we're always doing cost segregations. And you can actually even catch up on a cost segregation. So if you bought a building back in 2014, you can catch up your depreciation by doing a cost segregation now. But let's say you bought a property after 2017. Now we have bonus depreciation. It doesn't matter whether it's new or used. And what bonus depreciation does for real estate is those land improvements and the contents, which on average we're seeing in a cost segregation come out to be about 25 to 30% of the property cost. They get depreciated the first year. So 100%. So just, let's say you buy a small building, $1 million building, and you put down $200,000 on that building, you could get a deduction the first year of somewhere between $250,000 to $300,000, even though you only put $200,000 into the building. So and it's just a huge benefit. The challenge is I'm just not seeing those benefits come through on K1s to investors the way I think they should come through. And some of it is because the syndicator in the deal is that their CPA is not understanding bonus depreciation. And some of it's because the syndicator is misallocating the depreciation. So I've seen a lot of mistakes in the bonus depreciation. And again, it's just an enormous tax benefit. I mean, you consider a $300,000 tax benefit on a $200,000 investment. You're in a 40% tax bracket. That's $120,000 of tax you're not paying, which is probably a better return than you're going to get in the first 5 years on the building.
Yeah, that's absolutely amazing. I love that. If you could, I don't want to just skim over, but the the misallocation of depreciation. Some of the mistakes, I guess, that you've seen, and what exactly those mistakes are. Just in case those that are listening, their CPA fully doesn't understand this and the benefits behind it, that they might be able to go educate their tax advisor to some of these common mistakes.
Yeah. So let's say you have a syndicator, and the syndicator doesn't put in any money, and they're going to get down the road, or even now, they get some split of the cash flow, right? Well, they don't have anything at risk in that project. Granted, they've got their time and so forth at risk, but they don't have money at risk. And so what the IRS says is, well, if you don't have money at risk, the people who have money at risk get the depreciation first. So if you've gone out and raised millions of dollars from your investors, they have to get the depreciation first. It's not like this is like you're doing them a favor. You don't have a choice. And that's the issue that I'm seeing, is that I'm seeing, which I think is, I have an issue with it as an investor in the first place. Why would you want to not help your investors in their tax side?
Sure.
But what I'm seeing is people think, well, wait a minute, my investors are all passive, which A, they're not, and B, so what? That doesn't mean they're not getting the tax benefit. So we probably ought to bring up that passive issue at some point. But let's say it doesn't matter, because the law is really clear. And the IRS just came out with some new regulations that made it even more clear that, by the way, if you think your bad boy guarantee, we're last dollar guarantee, you think that's going to help you get allocated some of that depreciation, think again. The IRS has been really clear that if you're not really on the hook for that loan, if it's truly a non-recourse loan, except for that bad boy guarantee, then you've got to allocate that depreciation first to your investors until they get losses equal to their investment.
Interesting. You see that being the most common mistake that comes across your desk?
Well, the most common mistake is that they're not taking bonus depreciation because because their CPA said, well, you're a syndicator, and because it's a syndication, that's treated as a tax shelter, and because it's treated as a tax shelter, you don't get bonus depreciation, and that's just a mistake. You can elect out and still get the bonus depreciation. So what you're electing out of, by the way, we have these interest limitation rules. These are brand new interest limitation rules. So what you want to do is you don't want to lose your interest deduction. I mean, that's a huge deduction for, real estate. But here's the thing. Most of the time, you can have both. You can elect out of the interest deduction limitations and still get bonus depreciation. And I think that's actually the number one mistake people are making. Number two would be the allocation of those losses. But the first thing is you have to, and even before that, I can't believe how many people aren't even doing a cost segregation. I mean, that's just shocking.
What was the ultimate objective of this tax reform, at least as it relates to bonus depreciation? Like,
first of all, let's be clear: the IRS didn't want it, Congress did, and more than that, the administration did. And why? Because they were afraid that the economy was going to collapse and wanted to kick the can down the road, and this was one of the ways to do that.
Got it.
I don't think it's any surprise that that it's real estate that got the tax benefit, giving our administration. Frankly, and real estate is a driver of the economy. There's no question. Everybody knows that. And so they were really, and there is still a need for, in the multifamily space, they say that we're still a few years away from catching up, from the demand for multifamily. So I think, it was really just a way to push money back into the economy and continue that construction boom.
What happens with the depreciation on any different type of investment structure? I mean, we could speak to passive investors because that's what we were chatting about before. But they get a certain amount of depreciation allocated to them, but that can't be put to use. I mean, let's say that they've literally got more depreciation than what they can actually make use of in that first year. What happens? Does it carry over?
Well, you got a couple of choices. First of all, you don't have to take all of the bonus depreciation. So you can say, look, I'm going to take bonus depreciation on the land improvements, but I'm not going to take it on the contents, because the contents I'm going to get 20% a year anyway. So you can actually choose on the classes. You can't choose between individual items, but you can choose on those on the classes. So you do have a little bit of leeway there on the front end. But let's say you decide, well, I'm just going to take the bonus depreciation anyway, then go ahead. It carries over as a net operating loss. So there's no downside there.
Yeah, fantastic. So being that there's so many CPAs or tax advisors that aren't truly up to speed with this, I mean, what advice would you give for folks that are seeking tax counsel? They're seeking an advisor that is up to date with the latest and greatest. I mean, obviously you, Tom, but generally speaking, what are some of the other qualifications that they need to be looking for?
Well, I think one of the big mistakes people make is they think all accountants are created equal. And that would be like saying, I'm going to go get my heart surgery done by my chiropractor. Probably not a good idea. And probably not a good idea to have your bonus depreciation. You've got this big property with tremendous tax opportunities to it, to go to a local a local or a big company CPA. Even the big firms are completely missing this, and where they're not specialized in real estate. I mean, this is a specialty. Real estate is for sure a specialized area of the tax law, and so find somebody who specializes in real estate. Preferably somebody who actually invests in real estate. There you go. And somebody who specializes in that area of the tax law, because it is a specialty. What this is the number one question that I get when I travel and speak is, where do I find a CPA who understands this stuff? And I said, well, so what we did, we actually created a network of CPAs that would understand that I could teach this stuff too. So we pretty much have the easy button. At Wealthability is our easy button. You want to find a CPA, we're happy to help you find one. We don't charge for that. So That's basically what we did. We just had too many people asking us, and I had no way to help them. So we just decided to build it.
Yeah, and I don't want to digress here, but please speak to that a little bit. Speak to what Wealthability is. I mean, I mentioned it here in the introduction that you're the CEO of Wealthability, but what is Wealthability, and ultimately, what kind of resources can it help those folks that are listening in here today?
So we have a network of CPA firms, and they range from handling entry-level people who, are just starting to invest, all the way up to very sophisticated investors and doctors, lawyers, and entrepreneurs who make, millions and millions and millions of dollars. So it's a very wide range of accounting and CPA firms, and we even have some that aren't even CPAs. So they're handling more of the, lower end, just starting out, or the consultants, people like that. And we wanted to do that. We want to make sure that we could serve as many people as possible. And then what we do at Wealthability is we train them. So we're kind of the Marine Corps of accounting networks. I mean, I'm really demanding with my people. And if, some people, the nice thing that we've been able to do is people, we got to a point where we couldn't handle the number of clients coming in. So we started building this network. Now what we can do is, if you like your CPA, we can train your CPA too. So we have services for your CPA. If you go, wow, I think my CPA is great, but boy, they really need to learn this stuff. Great, send them to us. Or, you know what, my CPA is never going to learn this stuff. So then you come to us. So either way, we're just out there to basically completely overturn a profession. But other than that, nothing big.
Okay, fantastic. And guys, he also has an amazing podcast as well, and he's had incredible guests on the show. Covers lots of very relevant topics, which you can find the podcast as well on wealthability.com. So, getting back to the main topic of discussion here, is there anything else relevant related to bonus depreciation that we might have missed on, Tom?
Yeah, absolutely, and that's your home office. So let's say that you're a serious real estate investor. You have a regular job, but you're an investor and you're investing in real estate on a regular basis. You should have a home office, and because a home office is, or let's say that you're an entrepreneur and you're investing in real estate. You should have a home office. You might even decide you want a different home office for your real estate than you do for your business. And the reason this affects bonus depreciation, we were talking about this earlier before we started, is that, when you don't have a home office, then the first trip of the day you take and the last trip home, no matter where you're going, even if you're going to go visit a property that you own or that you want to own, is called a commute. And commuting is not deductible. Mm-hmm. So that's a big part of your automobile expense. And so a big part of your automobile expense probably is not deductible if you have that commute. What the IRS says is, if you have a home office, your commute is the 30 feet from your kitchen to your home office in the morning. And then your commute at the end of the day is the 30 feet from your home office back to your kitchen. Because we all know that the two bookends of the day are coffee and wine, right? So we do the coffee in the morning. I know some people do the wine in the morning, but let's stick with the coffee in the morning. Then we go to the home office, we do our administrative tasks, we get a good start on the day. We go out and travel, and we come back and we spend, at the end of the day, we do our home office tasks again, and before we go have our glass of wine. And what happens is that now we're qualified for higher depreciation and deductibility of our car expenses. But with bonus depreciation actually applies to cars now, and it didn't used to. And so now you buy a passenger car, in the first year, your deduction is up to $18,000. And if you buy a truck or an SUV that's over 6,000 pounds gross vehicle weight, which is not, believe it or not that big of a car. It's a full-size SUV, okay? But if you buy one of those after 2017, you get bonus depreciation equal to the cost of the car, even if you didn't put any money down on the car. So you put zero money down on a $60,000 SUV or a $50,000 pickup truck and you get the whole thing deducted the first year, potentially, if you have a home office. But if you don't have a home office, there's no way you're going to get that deduction. So this is the one that people miss all the time because their accountant said, well, it's a red flag, which, by the way, it should never be a red flag. Okay, if you do it right, it will never be a red flag. Because the IRS actually, there's no place to notify the IRS that you have a home office. So it can't possibly be a red flag. But that aside, why would you give up a $50,000, $60,000 or even an $18,000 deduction just because you don't have a home office and maybe your accountant's not willing to, take the time to do it? It's not that hard.
So assuming that you were to go through an audit, what exactly is the IRS looking for as far as like what classifies this space in your home as a home office? What does it need to have?
It is only used for your office. I give you a simple example. So I have a home office. I actually don't really have an office at the office. I go there just to meet with staff and partners and once in a while a client. I mostly work out of my home office, but I also have a room that I'm in right now that I'm doing. I use as a studio, but it has a bed in it. And that bed is used when I have people come from out of town as an extra. It's used as an extra bedroom for family, and so it doesn't qualify as a home office. So this room that I'm in right now does not qualify. The other room that I only use as a home office does. So it just needs to be a space that you only use for home office, and then it qualifies, and then it qualifies your car, and it qualifies your utilities, and it qualifies your home mortgage interest, which now is limited, and it qualifies your taxes, which are now limited. It qualifies your cleaning lady, your cleaning people, which is now, which would otherwise be non-deductible.
Is it just proportionally based on the size of that office space?
The IRS gives us two choices. Well, there's a third choice, but it's a bad choice. So the two real choices are square footage or number of rooms. And we find that number of rooms typically is a better percentage than square footage. As long as your rooms aren't, one's not just gigantic compared to the others and they're pretty reasonable size, then that should not be an issue.
Got it. Okay. What are some of the other, we spoke to bonus depreciation. What are some of the other parts of the Tax Cuts and Job Act that you find to be misunderstood? Are there any other big benefits that were in there? We know bonus depreciation was the biggest of all, but are there any other big benefits that came along with that tax reform?
Yeah, for sure. And one that real estate people, I think, are not paying attention to, and they're probably not paying attention because of the bonus depreciation, frankly, is that if you do have positive taxable income, then you've got this 20% deduction. And that means that your taxable income gets shaved by 20%. Well, here's why that's relevant to bonus depreciation. Bonus depreciation basically takes all your depreciation, except for the 50% or so that's allocated to the building, takes all your depreciation in the first year, which means that the first year you got a big loss, but year two, you're probably going to have positive taxable income. But then that year two, now you're only taxed at 80%. So this is actually very similar. If you look at, because you're asking about policy, if you look at oil and gas historically, you've got an intangible drilling cost the first year, and then when it starts producing income, you only get taxed on 85% of the income because that 15% is called depletion. Well, if you look at it, real estate is really now substantially like oil and gas, only better, because you get this huge deduction, which can easily be more than 100% of your investment the first year. And then when you pick it up, you only pick up 80%. So a lot of people are familiar with oil and gas, with that intangible drilling cost deduction. This is really putting real estate on a par with oil and gas and how the deductions and how the income works. And here's the thing. Most real estate investors also own their own business. Okay, so you own your own business, you're probably qualified for that 20% deduction because it's called a qualified business income deduction. And my experience, unfortunately, I was speaking last tax season, January through April. I spoke every single week to some group of entrepreneurs. And there wasn't, I remember speaking to a group of 50 entrepreneurs, this small little group, but I spoke to 50 and I asked them how many even knew about the 20% deduction. And only one person raised their hand.
Wow.
And they all qualified. So if they don't know it, it doesn't mean they're not getting it. It just means that their accountant's not explaining it to them.
Sure.
But what's going on is the accountant is going, well, in fact, at this course I taught last week, we taught this 20% deduction. And I heard a few people in the audience say, well, I just checked the box on the computer. I'm going, yeah, that doesn't work because there are lots of decisions you have to make before you ever get to checking the box.
TurboTax is not going to cut it.
And whether it's TurboTax or one of the other, even one of the more sophisticated ones that professionals use, it's just not enough. You have to understand the stuff. And there are opportunities to increase the deduction. So you may be limited, and there might be ways that you could not be limited. I mean, you might have ways to vastly improve that deduction. You're talking about 20% of your income, no matter who you are, that is a big number.
And what determines if it's a qualifying business or not? What's that classification?
The only businesses that aren't qualified, it's really by exclusion. So the only businesses that aren't qualified are basically service businesses, and only to the extent that it's service income. Let me give you an example. So healthcare services, right? So a doctor clearly isn't going to qualify, by the way, nor does an accountant. So our lobbying was really bad in this last tax bill. By the way, engineers and architects who are also professional service, are service professionals, they had really good lobbying and they qualify. Okay. But for whatever reason, they do, we don't. Now, take healthcare services. So take a pharmacist. So let's say a pharmacist owns their own pharmacy. And you go, well, that's healthcare services. Well, it's not. It's retail. Mm-hmm. And the IRS has issued regulations on this, and they were actually really, really good regulations. They're very clear, and they're very narrow in what they exclude. So, for example, a flu shot. Let's say you're a pharmacist, you give a flu shot. Well, the charge for giving the shot, that's doesn't qualify, but the shot itself, the drug, that does qualify. So for pharmacists, for example, anybody who owns their own pharmacy or their own retail store of any kind, they're probably going to qualify for this tax benefit. And on top of that, and then they probably got real estate besides, and they probably qualify for their real estate as well. And actually, even if you might even have very little income from your real estate, and your real estate might help you get more of a deduction from your business. So the thing that people miss, and this is what this course was all about that I taught CPAs, is that people miss that tax laws are not independent of each other. They are actually quite dependent on each other. And if you have somebody, an advisor who understands how the tax law all works together, which was, by the way, and if they don't, have them read my book, Tax-Free Wealth, because that's the whole point of it. And they really have to pull all the different tax laws together because it is complex. We all know it's complex. But they need to pull those tax laws together to give you the best result that you can get. And remember that these are all incentives that were intended by the government. These aren't loopholes. Bonus depreciation is certainly not a loophole in the law. The 20% deduction is not a loophole in the law. These are very much intended consequences to help businesses and real estate investors and oil and gas investors and agriculture and basically anybody who's producing outside of an employee, because employees got hammered. But everybody else got huge tax benefits, and they want you to take advantage of the tax benefits.
Okay, fantastic. Is there anything else that you've seen to be very misunderstood as it relates to this tax reform?
As it relates to real estate, you know what? I think those are actually the biggest ones when it comes down to real estate. And bonus depreciation is so big that it kind of overshadows everything else. But I wouldn't discount the 20% deduction because I think, let's say you bought a project in 2019, now that's this year, you're probably going to have taxable income from it, and you may have an opportunity to do something about that. I would say the other thing that people misunderstand, though, because it's very much affected by this, is the passive loss rules, which people assume that, well, if I'm a limited partner or if I'm not a professional investor, then I can't get my losses from the bonus depreciation. That is just absurd, because passive losses are fully deductible against passive income. The question is, how do I generate passive income, or how do I convert income that's not passive to make it passive under the law? So if your accountant's just telling you don't do, bonus depreciation is not going to help you because you're going to get passive losses, and passive losses aren't deductible. I'm going, that's absurd. Passive losses are fully deductible. They're only fully deductible against passive income. So, okay, tax advisor, help me figure out how to create passive income.
The simple answer to that is probably find a new tax advisor. That's the advice that you're getting.
Probably is. In many cases, that's exactly what it is. Or get your tax advisor trained.
Yeah. Fair enough. And how about Section 179? That's not really relevant for this conversation, is it?
It is. Thank you for bringing that up, because there actually are changes that affect commercial real estate. So, and only commercial real estate, right? Not if somebody lives in the property, it doesn't qualify. So, by the way, by commercial, we're talking about office and retail and stuff like that. We're not talking about a big multifamily. Multifamily is residential for tax purposes. So in commercial, though, now roofs qualify. You put in a whole new roof, it qualifies for Section 179. So you get to deduct that. You put in a new security system, which would otherwise be part of the building, or HVAC, or a fire alarm. So those four things used to not qualify for bonus depreciation or for cost segregation or anything else, or 179, because they're really essential to the buildings being able to be used. So they don't qualify for these other bonus depreciation rules. They got a special exception, though, that they qualify for Section 179, and that can be a big number too. So just because it's a roof and doesn't qualify for bonus doesn't mean it doesn't qualify for Section 179. Yeah,
got it. And I was doing some additional digging in 1202. Is that relevant at all to this discussion?
So 1202 is an interesting provision. It's very relevant if you're a business owner. Probably less relevant to real estate. Because 1202 is for an active trader business, and it basically says you have to be a C corporation, which in real estate we don't want to be a C corporation because we lose the benefits of the bonus depreciation, right? So, but if you're an active trader business, then after 5 years you don't get taxed. Now, the other one we haven't talked about that is a huge one for real estate is opportunity zones, and this is, I would guess, the most misunderstood of all the laws outside of the international laws under the new law. And this is really cool because you take the gain from selling a property. So, I mean, take a typical passive investor, limited partner investor. You're never going to do a 1031 exchange in a syndicated deal, right? It just doesn't happen. But you've got gain. Prices are high right now. So people have gains. What do they do with that gain? They can't do a 1031. Of course, they can put it back into a new project, take bonus depreciation. So that's an option. But another option is take the gain, just the gain, not the total proceeds, just the gain, and roll it into an opportunity zone project. And if you do that, then that gain is deferred till 2026, the earlier when you sell it, or 2026. And the project you invest in, the appreciation on the project after 10 years is completely tax-free. So unlike a 1031 where you have to keep rolling in an opportunity zone, if you hold it for 10 years, then that now not the deferred gain, but all of the appreciation in the property, it gets eliminated. It just goes away forever. So it's a pretty cool it's a pretty cool opportunity if you want to be developing kind of on the edge of civilization. You want to go into those areas that are redevelopment areas, and which are great, typically great opportunities. If you want to do that, an opportunity zone is a great way to do it.
Yeah. I'd love if you could go back to that strategy again, because I think that's, one of the biggest hangups I think a lot of folks have is getting out of getting out of a syndication. You obviously can't 1031, as you had mentioned, but deploying that gain into a, one of the, maybe the opportunity zone funds, and then, taking the original basis and putting that into another syndicated project, taking the bonus depreciation. Can you walk through that one more time? I just want to make sure everyone is absolutely clear and they understood what you just said there, because I think that's a real strategy. That's one that's incredibly relevant and applicable today.
For sure. I mean, let's say, for example, let's say that you got $200,000 back from the sale of this project. Mm-hmm. And let's say of that, $80,000 is capital gain, right? And 1231 gain, by the way, qualifies. So it would qualify as capital gain for this purpose. Okay. I've got 120,000. I could just take that 120 and put it into a new deal. And I'm going to get bonus depreciation on that new deal. I can take that 80,000 and roll it into an opportunity zone fund and not have to pay tax on the 80,000. And then the appreciation on that 80,000 gets eliminated after 10 years. And actually, even the 80,000 you rolled over, 10% of that gets forgiven after 5 years. So if you hold it for 5 years, basically of the $80,000, $8,000 is forgiven. Right, so you only pay tax on 72,000 when you do sell it, and then if you hold it 10 years, then while you're paying tax on the 72,000, you're not paying tax on the appreciation. In the meantime, you got bonus depreciation from putting your $120,000 into a different deal. So to me, like the tax benefit opportunities here are like endless. It's nirvana.
Yeah, no, that's awesome.
This stuff, it's nirvana.
Good deal. Well, Tom, this has been fantastic conversation. I want to enter in what I like to call the lightning round. We're gonna try to, I guess, turn up the fun a little bit, right? I know we talked about having.
We'll see how we can do that.
Yeah.
We'll see how we do it here.
So 6 questions, 6 short questions, 6 concise answers from you. First one, biggest fear. What is it?
Lack of approval.
Okay.
I am a total approval whore. So, people tell me they like me. My biggest fear is people don't like me.
Okay.
It's just something you have to, sometimes you just got to realize what your weaknesses are.
That's it. That's absolutely. Got it. How about one biggest regret?
My one biggest regret is a few years ago, I got divorced, and the woman I ended up marrying, my current wife, I knew her 15 years earlier. And my biggest regret would been not pulling that trigger 15 years earlier. Got it.
Okay. We live and we learn, right? Most influential business book?
I would honestly have to say Good to Great.
Yeah, that's a good one.
It's just one of those, we've got a whole lexicon from that book, right? Like getting the right people on the bus and getting the people into the right seat, and the hedgehog concept. I mean, all of these came from that book. You're going, wow, when a book gives you a whole new language, it's a great book.
Yeah, Jim Collins is the man for sure.
Now, the other business book, I can't say Rich Dad, Poor Dad, is no, I would be really remiss to not include Rich Dad, Poor Dad in that group. But for me personally, it really was Good to Great.
Okay. How about outside of the daily work grind, what do you do to decompress?
I do triathlons.
You do? Good deal.
Yeah, I'm a swimmer. And I have a 25-meter swimming pool in my backyard, and it's heated in the winter and it's cooled in the summer because it's hot here in Arizona. And I love to swim, and I love to run and bike. And
that's the swimming was the one part. My wife and I for many years did triathlons, and she was a runner. I was a cyclist. I got into running. She got into cycling, and both of us just never found the love in the swimming part after hiring multiple coaches and taking years going to swim practice in the evenings and at 5 a.m. And I'm like,
oh wow,
I don't like that. Why am I doing something I don't like? I think we both looked at each other. We're like, this is really stupid. Like neither one of us are really good at the swimming part. Like we enjoy the competitive nature of the sport.
Sure. I'd go I used to go to the pool, and I'd watch people swimming going, man, they swim like a runner. Unfortunately, I run like a swimmer.
Yeah, no, that's good. You started off swimming, it sounds like. So
I grew up swimming competitively. I swam competitively from the time I was 7 all through high school. So I love swimming. I'm much more at home in the water than I am on land.
Yeah, I think I have nightmares still. The YMCA we used to go to, it was an outdoor pool, and they said it was heated, but that thing was not heated. And I know we're in Florida, so I can't be bitching about it getting cold here, but you've got 50-degree mornings, and the last thing you want to do is jump in that pool at 5 a.m., you know?
And here's the thing. You're in a triathlon. If you're running, you can walk.
Yeah.
If you're on a bike, you can coast.
Yeah.
If you're swimming, you drown. So,
yeah, absolutely.
Very much more serious. Swimming is a much more serious of the three.
It surely is. We're getting both of our boys started very early in the sport.
Great.
So
it's absolutely a great sport.
Yeah. How about the one thing that you can't live without?
My wife.
Okay. And then lastly, what would the backup plan be if one day you decided, that when you woke up in the morning, you just didn't want to do what you're doing today, which is a tax advisor, coach, trainer, what have you? What would you do with your free time?
I just can't even imagine it. Just because I love what I do.
Uh-huh.
I would just learn. I'd learn something new. It'd be a new business venture, something new, something different, just new technology, whatever it is. I absolutely love to learn.
Fantastic. Moving on here. Tom, I know that you've got the Wealthability website. You've also got a podcast. We had mentioned that before. What else can folks find on your website there? I know you've got about 40 or 50 episodes up there for your podcast, which you got to check it out. Lots of phenomenal content. You've had lots of great guests. You've covered lots of very relevant, important topics.
We actually have a whole learning management system of courses on wealth and tax. And so we use those with our with the clients of the Wealthability Network. The other thing we have is we now have a Wealthability show for CPAs. So this is one that you're going, geez, I'd really like my CPA to get a little more in tune, be able to do a little more, then make sure they listen to the Wealthability for CPA show. But the Wealthability show is, I got to tell you, it's a lot of fun. I mean, as you know, you've been doing a podcast for a long time. Podcasts, they can be a lot of fun. They're work, but boy, I love the guests that we get on the Wealthability show. They're awesome.
No, it's definitely been a lot of fun. I've had a good 6-year run with it, so lots of fun here. Well, Tom, moving on here, and as we work towards exiting out of the show here, what I'd like to ask you is if you could leave just one final gold nugget of advice or wisdom with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be? The best lesson I ever got in college was from a tax professor, and she said, the great thing about tax law is the more you know, the more you realize you don't know. And I think if we applied that to every area of our life, we would be much more successful, because I think what people do is they tend to most people stop learning after high school or college. Mm-hmm. And I think that my mother was a lifetime learner, as was my father, and my siblings. We've all been lifetime learners. And you know what? There's just a lot we don't know. And so there's just always an opportunity to learn something new. That's interesting. I think I'm the opposite. I barely scathed by in high school and in college, and then really enjoyed learning thereafter. And so today I can't get enough of it. So I wish I'd just put my act together back then. I'd be much further ahead now.
Well, I wish the education system was such that you would have wanted to.
That's it. Exactly. Well, Tom, it's been a lot of fun having you back here. Really appreciate you coming back on the show. And folks, again, to learn more about Tom and what he's got going on over there, it is his company, Wealthability. You can go to wealthability.com. Tom, thank you again. And guys, thank you to each and every one of you for tuning into this week's show. Until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.